In this video, I am going to discuss about budgeting. Budgeting is the process of planning and controlling an organization's financial resources. These financial resources can be cash or any resource that has a monetary value or a financial value. Another important thing to note is that budgeting is not only about the planning but also about the controlling aspect. It involves setting financial goals, creating a plan to achieve those goals, and monitoring progress against the plan. What is a budget? A budget is a financial plan that outlines an organization's projected or future income and expenses over a specific period of time, typically a year. This is also important. Management accountants prepare budgets for the future. They do not prepare budgets for the past. And budgets are prepared on income and expenses over a specific period of time. So, a budget has a specific period of time, typically a year. This can change depending on the industry and the organization. A budget serves as a blueprint for financial decision making, helping an organization to prioritize spending and allocate resources effectively. A budget can be created for an entire organization, a specific department or project, or even for an individual. This means a budget can be prepared for any level of an organization, from the individual level to the entire organization level. Budgets are typically created on an annual basis, which means every year, but can also be developed for shorter or longer periods depending on the organization's needs. A budget typically includes two main components: revenue and expenses. Revenue are the money coming into the organization. Expenses are the money going out from the organization. Revenues are the money an organization expects to receive during the budget period, such as sales revenue. Sales revenue is the main source of income for an organization. Expenses are the costs the organization expects to incur, including salaries and wages, supplies, rent, utilities, and other expenses necessary to operate the organization. What is the budget period? The budget period refers to the length of time that a budget covers. It can be any length of time, but is typically 1 year. The budget period is the time frame during which the organization's financial activities will be planned, executed, and evaluated. For example, a company will create a budget for the fiscal year from January 1st to December 31st. What is the difference between the fiscal year and a calendar year? A calendar year is the 12 months starting from the 1st January to 31st December of the same year. This is a calendar year. A fiscal year can be any consecutive 12 months. So it can be also 1st of January to 31st of December of the same year. These are 12 consecutive months. And it can be 1st of April to 31st of March next year, as long as there are 12 consecutive months. The budget interval refers to the frequency at which the budget is updated or revised. Budget intervals can vary depending on the organization's needs and can range from monthly to annually. A budget interval determines how often an organization will review and adjust its financial plan based on actual performance. For example, a company may review its budget on a quarterly basis and adjust its projections and spending accordingly. Quarterly means every 3 months. There are 4 quarters in a year. Now let's discuss about the purposes of budgeting. Why the management accountants use the budgeting. They use budgeting for planning, control, communication, performance evaluation, resource allocation, decision making, coordination, motivation, authorization, and responsibility accounting. Now let's discuss about each of these purposes one by one. Planning. Budgets help organizations plan for future activities by setting financial goals and outlining the resources needed to achieve those goals. By creating a budget, organizations can anticipate potential challenges and identify opportunities for growth. Control. Budgets provide a framework for controlling an organization's financial activities. They serve as a benchmark against which actual performance can be measured, allowing managers to identify areas where expenditures are exceeding budgeted amounts and take corrective action if necessary. Communication. Budgets are an important communication tool, enabling managers to share financial goals and expectations with employees, stakeholders, and other external parties. Performance evaluation. Budgets can be used to evaluate an organization's performance against its financial goals by comparing actual results to budgeted amounts. These are known as the variance analysis. This is a very important topic under budgeting. We will discuss about variance analysis in a separate video. Managers can identify areas where performance is strong or weak and take action to improve financial performance. Resource allocation. Budgets help organizations allocate resources effectively by identifying priorities and setting limits on spending. By creating a budget, organizations can ensure that resources are allocated in a way that maximizes their impact on achieving the organization's goals. Decision making. Budgets provide a framework for making informed financial decisions. By having a clear understanding of expected costs and revenues, managers can make decisions that are aligned with the organization's financial goals. Coordination. Budgeting can promote coordination among different departments within an organization by establishing a common set of financial goals. Budgeting can encourage departments to work together to achieve those goals. Motivation. Budgeting can provide motivation for employees to achieve financial targets by setting clear goals and offering incentives for meeting or exceeding those goals. Budgeting can improve employees to improve their performance and contribute to the organization's success. Authorization. Budgeting can provide a basis for authorizing expenditures by setting spending limits and allocating resources based on a predetermined plan. Budgeting can ensure that expenditures are authorized in a consistent and controlled manner. Responsibility accounting. Budgeting can facilitate responsibility accounting by assigning responsibility for specific financial outcomes to different individuals or departments within an organization. By holding employees accountable for meeting financial targets, budgeting can encourage them to take ownership of their work and strive for success. Now let's discuss about the disadvantages of budgeting. Time consuming. Preparing, reviewing and updating budgets can be time consuming, especially for organizations with complex financial activities. Rigidity. Budgets can be inflexible and may not accommodate changes in the business environment. Unrealistic expectations. Budgets may contain unrealistic expectations which can lead to frustration and demotivation among employees. Lack of participation. Budgeting may lack participation from employees and managers, which can result in limited buy in and commitment to the budget. Overemphasis on short term goals. Budgeting can lead to a focus on short term goals at the expense of long term strategic planning. Not considering non financial factors. Budgeting often focuses solely on financial factors, which can lead to decisions that prioritize financial goals at the expense of other important factors, such as employee morale, customer satisfaction, and environmental impact. This can have negative consequences for the organization's reputation and long term sustainability. Thank you for watching. See you in the next video.